So the Earned Income Credit and the Child Tax Credit are federal tax benefits for lower and moderate income workers. The purpose of these credits are to offset income and payroll taxes. They also supplement wages and provide a work incentive. And for the Earned Income Credit, a work incentive is built into the structure of the credit. These tax credits are unique and they are important because they are refundable, meaning that they will provide money back to workers. They help to reduce taxes workers may owe, and even if workers don't owe taxes, they may be eligible to receive a refund. And that is one of the key outreach messages, because some people who don't owe taxes may assume that there's no need to actually file a tax return, and we know that one of the main reasons, one of a huge incentive, is that you may actually be eligible for a refund. Finally, some workers are able to claim both the Earned Income Credit and the Child Tax Credit, in addition to other tax benefits that can be useful for low and moderate income workers. So let's take a look at the Earned Income Credit. Next slide, please. Thank you. So the Earned Income Credit is adjusted for inflation each year. This slide shows the value and the income guidelines for tax year 2014, which we will be filing for during the upcoming tax season. The Earned Income Credit is based on the number of children a worker has, as well as their income. And in the last column in this slide, you can see the maximum value of the Earned Income Credit. So it's worth a maximum of $6,143 for tax year 2014. There are different income guidelines for single workers and for workers who are married and filing jointly. For workers without children, there is an age requirement for those workers. This only applies to workers without children. They must be between 25 and 64 to be able to claim the Earned Income Credit. And one other factor that affects eligibility is investment income. One cannot have investment income that exceeds $3,350 even if their income is less than these amounts that are shown on this table. And investment income is not just having money in a savings account. It refers to the interest off of types of investments, such as capital, such as stocks, bonds, and capital gains distributions. Now let's take a look at the child tax credit. So the child tax credit is structured a little differently. Next slide, please. And the child tax credit refund will kick in when one earns more than $3,000. They'll get a child tax credit refund, also known as the additional child tax credit. So here you can see the income guidelines are much higher than for the Earned Income Credit, and one can also claim the child tax credit if they are married filing separately. You cannot claim the Earned Income Credit if you're married filing separately. The child tax credit is worth up to $1,000 for each qualifying child, and there is not a maximum on the number of qualifying children that can be claimed for a household. So why are these credits so important? They represent a lot more than just receiving extra money. On the next slide, we can see how workers tend to use the credits. So research shows and supports that workers primarily use these credits to take care of themselves and their families. They use the credits for expenses such as rent, utilities, mortgage, groceries, school supplies, medical expenses, clothing, home repairs, transportation, and for savings. So these credits are important and they're significant because they help workers keep working and care for themselves and their families. These credits are also an anti-poverty tool. On the next slide, we'll see that in 2013, the Earned Income Credit and the Child Tax Credit lifted more than 9 million people above the poverty line. So this shows the impact that these credits can have nationwide.